Hi everyone. Our topic tonight is capital expenditure. We want to look at various techniques of capital budgeting. So, as we discussed earlier, we've explained the meaning of capital expenditure planning and control. Please, if you did not attend our first class, capital expenditure planning and control, kindly go and attend the class before you attend this class. So, we'll be looking at one of the techniques of evaluating capital budgeting. So we'll be looking at payback period, and we discussed in our earlier class on the advantages, disadvantages, the meaning of payback period. Then we discussed about decision rule. Yeah. So let's quickly go to the question now and find solution to this question. So here is the question. KK Limited is faced with a problem of whether to accept to invest in a project or not. The project requires 3 million and it is expected to generate net cash flow of 1.3 in year 1, 1.1 in year 2, 800,000 in year 3, and 1 million in year 4. If the management of the company had set the maximum acceptable period of 2.5 years, should the project be embarked upon? Should the project be embarked upon? So let's evaluate the project now. I want to check whether the project should be embarked upon. So the first thing you look at is the initial capital outlay. The project requires 3 million. So this is the initial capital. Initial capital outlay or initial cash outlay. They are the same. This initial capital outlay or initial cash outlay is the initial capital that will be invested in the project. So if you look at the question now, you can see that our initial capital outlay is this 3 million. So our initial capital outlay is 3 million naira. 3 million naira. So let's proceed. How to calculate the payback period? How to calculate the first thing you need to do, all right, years. Then we write cash flow. So the cash flow are the income generated by the investments. So cash flow. Then we write cumulative cash flow. Cumulative cash flow. So we start from year 0, because year 0 is the year of investing the initial capital outlay. Year 0. Then we put our initial capital outlay under the cash flow. So we can put our naira symbol on top like this, naira symbol. So 3 million. So you bracket it, the 10 million. Then you now say year 1. How many years we have from year 1 to year 4? We have year 2, right? Year 2. Then year 3. Then year 4. So in year 1, this 3 million will generate 1.3, because let's look at the question. And it is expected to generate net cash flow of 1.3. 1.3. That's in year 1. Then in year 2, it will generate 1.1 million naira. 1.1 million naira. Then in year 3, it will generate 800,000 in year 3. 800,000 in year 3. Then in year 4, and 1 million in year 4, it will generate 1 million in year 4. So our 3 million, which is the initial capital outlay, you have to write it again here, bracket it. So this 3 million naira generates all this. We generate all this net cash inflow. So we will now be reducing this 3 million by all this net cash flow that is being generated by the 3 million. So we say the first one, 1.3. Yes, we have to use our calculator for this. You see 1.3. This is in negative. 3 million is in negative. 1.3 is positive. We just say, you can say 3 million, because the 3 million is in negative already. So you can say minus 3. Let's check this. Minus 3 million plus 1.3. Let's try this whether it will. Okay. You say minus 3 million plus 1.3. So we got 1.7. 1.7. You got minus 1.7. Minus 1.7. So we have to bracket it again. So the second one now, this minus 1.7 will also be reduced by this 1.1. So we now say plus 1.1 million. 1,100,000 is equal to 600 minus 600,000. We bracket it again. Minus 600,000. So the next one, we can see that this 800,000 is extremely larger than this 600,000. That is, we can only take less value away from this 600,000. So if you look at it, it is impossible. So we now do it in this way. The number of years we've calculated before, year 1, year 2, for this year 1, year 2. So we ring this one. We roll it like this. So year 2, we've calculated year 2. So we now say payback period. Our payback period. This is our calculated payback period. Our payback period will be 2 years plus this 600,000 over 800. 600, don't forget this year 2. We stop at this year 2. So the figure in front of that year 2 is 600,000 naira. So we now use it as a numerator for the year 3. So it will now be 600,000 naira over 800,000 naira. So either you put negative or not, You must get the same thing times 12 months. 12 months. You say 12 months times 12 months. So let's use our calculator. 600,000 divided by 800,000 is equal to 0.75. So we can 2 years plus 0.75 times 12 months. So it will now become, that's 0.75 times 12 is 9. So 2 years plus this one 9 months. So our answer is 2 years and 9 months. So this is our calculated payback period. Our calculated payback period, we cannot say calculated payback period is equal to 2 years and 9 months. 2 years and 9 months. So let's check whether the project should be accepted or not. As you can see, we are having only one project here. So the decision rule will be accept the project if the calculated payback period is less than the company's maximum acceptable payback period. So let's look at the company's acceptable payback period. So let's look at the question. If the management of the company had set the maximum acceptable period of 2.5 years. 2.5 years is 2 years and 6 months. 2 years and 6 months. 2 years and 6 months is less than our calculated payback period. That means that the calculated payback period is higher than the company's standard, is higher than the maximum acceptable period of the company, which is 2.5 years. So the project should be rejected. This project should be rejected because it is higher than the company maximum acceptable period. So we now say, we first list the decision rule. We first write our decision rule because that's how we normally do it. You say decision rule before we write our own decision rules. Accept a project if the calculated payback period, if the calculated payback period is less than the maximum, that is this one, maximum acceptable, is less than the company's maximum acceptable period. Yeah, we are talking about only one project because only one project is involved. There's no mutual exclusive projects. So, so we cannot say our decision now. And even before the decision, if you like, we can still write the decision rule for mutually exclusive projects. If mutually exclusive projects are involved, the payback period, the calculated payback period that gives shorter period should be accepted. Okay, so let's quickly look at our decision now. Decision, our decision, go. This is our decision. So you say reject the projects because we are rejecting the project. Reject the projects because you must give your reason. Because the calculated payback period is higher than the company's maximum acceptable period of 2.5 years. So that is how to calculate payback period and how to make decision when only one project is being given. So in our next class, we'll be discussing about mutually exclusive projects. Mutually exclusive projects. That is where we are having independent projects and we want to choose out of the two or three. Thank you.